Hey guys, welcome back. Today we need to talk about some earnings that just dropped this past week. I'm going to go over Microsoft, Meta, Amazon, and SoFi. I'm going to go over the numbers, what happened during this quarter, and whether or not I think that my projections changed, and whether or not I think it's still a buy today. So, starting off here with Microsoft. Microsoft had a phenomenal quarter. Total revenue was up 17%. Total cost of revenue was up 22%. So definitely higher than total revenue. But this is something that they can't control quite as much as, say, research and development, sales, general and administrative. And all those numbers were quite low compared to revenue. Research and development up 13%. Sales and marketing up 4%. General and administrative up 14%. So total operating income was up 18%. So did the 22% have an effect? Yes, but their operating income was still higher than their total revenue, which is a good sign. Net income was up 31%, largely from this one-off here from other income. So great numbers from Microsoft. Operating income still higher than total revenue. So, and also keep in mind their Azure's growth, which is their cloud computing, was up 43%, which is a really good number from them. I believe this is higher than what Wall Street's expectation for growth rate was, which they really love to see that. I really like to see that as well. So I'd give them a 5 out of 6 stars. 95% grade here. Great earnings from Microsoft. What happened to the stock? Well, since earnings up about 18%, Wall Street really happy with what they did here. I really like their numbers. Great earnings from them. But what about the evaluation for Microsoft? So plugged in their revenue, their net income, and EPS here for 2026 and what's still projected. They're not going to get a huge lift here on net income, given how much they're spending with NVIDIA, AMD, all this AI build out. So 17% revenue, 17% net income. I think a 25 PE would be fair for a company like Microsoft. So I get around a 15, 14% CAGR. I know Microsoft's this SaaS play here, seen as software, so they've been beaten down recently, but I'd say they're roughly fair value here, maybe a small buy. If they went down over earnings, I would say definitely might step in for me personally, but I'd say fair buy. I get around a 15% CAGR, which is decent. But moving on here to Meta. Now, this earnings was really just a dumpster fire, in my opinion. Revenue up 28%. That's a solid number. But if we look here at their actual expenses, cost of revenue up 33%, research and development up 67%. Marketing, they kept that one in line, but general and administrative up 110%. They really did not keep that in check. They just did not do a good job here on expenses and keeping those in line. Total cost 55%. If your revenue is up 28, total cost and expenses up 55, that does not bode well for your income. So operational income fell for the company, 18,000 here. If you look at net income, that fell as well. EPS fell. This was really just not a good earnings at all for Meta. I give them a 2 out of 6 stars here, 30% if I was giving this a grade. Revenue was up nicely, which is great, but they just cannot keep their expenses in check. And this is not even considering how much they're spending on AI and that whole build out. So it's just not great quarter for them. Will they get this in check over time? I think yes, but it's just not a great quarter for them. What happened to the stock? Well, bad report, bad stock price. It fell around 10% after its earnings, came back a little bit, but honestly, I think they got off a little easy given this earnings. It just was not a good earnings report at all. But what about my projections for Meta? I believe that their net income is not going to outstrip their revenue over the next 3 to 5 years, given how much they're spending. Their expenses aren't in check. I'd say 13% net income growth. For my base case, a 20 PE ratio is probably fair for that. I get around a 16, 17 CAGR, so still good, but keep in mind, I think this bear case has a much higher chance than most bear cases, given how much Meta is spending right now on AI and this build out. Their free cash flow is probably going to be almost negative. Like they're just spending incredible amounts on this. So I wouldn't be surprised if this bear case could play out in the future. So keep that in mind. But just based on my base case here, fair value, I'd say it's fair. Maybe a small buy, but I wouldn't want to step in, but I don't think it's a bad buy in my opinion. Now, moving on to Amazon. Amazon crushed it. Net sales were up 19%. Cost of sales only up 18%. Fulfillment up 14%. Technology and infrastructure was up a little more than I'd like from sales, but this is something that many times helps the company in the future. I don't see it as a huge blown out number, so I'm not too worried about 22% there. Sales and marketing only up 1%. That's pretty incredible. General and administrative, this is even more incredible, down 6%. So unlike Meta here, this is flying high. Sales and marketing for Amazon barely going up, but your net sales are going up 19%. It's pretty incredible. Other operating expenses fell. So total operating expense only up 16%, but your total sales are up 19%. Operating income will fly, up 43%. Great numbers here. This is what I like to see. Net income was up 244%, but keep in mind they did have this one-off here in other income of $53,000 here. So that's a little distorted, but still would have been in a great number. EPS, great beat here. So I'm giving them a 6 out of 6 stars here. 98%. Just great numbers out from Amazon here. Now, what'd the stock do? Well, amazing numbers. Smiles all around. It was up around 15% after earnings here. So stock price did well. What about the projections I have for them now? Well, just like all the other big techs here, they're going to be spending a lot. Their net income and revenue is both going to be around 14% in my opinion. Analysts around 14, 15% as well. So right in line here with analysts over the next few years. 14% net income, 28 PE would be fair for Amazon given those growth rates. Around a 16% CAGR. Put my bear and my bull in there. So again, I think it's fairly valued. A lot of these big techs, in my opinion, are right around fair value. Maybe a small buy. You can make an argument it's undervalued, but 16% CAGR, I would say it's fairly valued. We'll see what happens with their spend on AI with these big techs and how the depreciation will play out in the future because they take massive depreciation from those. And it's a non-cash expense, but eventually you do pay for it. It's going to come back and hit you, so from depreciation. So we'll see how that plays out, but I'd say a lot of these are fairly valued based off my projections here into the future. Now, SoFi. This is a company many of you know I've been buying recently. I'm a huge fan of SoFi. So 44% total interest income. Some of their expenses here. Securitization and warehouse was actually down 36%. Pretty incredible. Deposits up 37, still lower than their income here. Corporate borrowings down 7%. So total interest expense only up 28%. So their total interest income flew upwards to 52%. If we go down here, total other income up 28%, total revenue 42%, still a solid number. So non-interest expenses down here, technology up 25%, sales and marketing was up a little bit more than total interest income, which you don't want to see that number, but given how much they're pushing and getting into like cryptocurrencies and that trading, I know they're running a lot of ads for that. So sales and marketing up a little bit more. It is an issue, but not a huge problem in my opinion. But 48%, still higher, but I'll put it in red. Cost of operations, 33%. General and administrative, 31%. So total non-interest expenses up 36%, still lower than their revenue. So love to see that. What does that mean for net income? Going upwards. 61% up for net income, given that their total expenses were lower than their total revenue up. That's why that number is so high. So I'd give SoFi 5 out of 6 stars, 95% if I was giving them a grade. Not totally perfect here, but great numbers, phenomenal numbers from them. But what happened here to the stock price after earnings? It fell around 11% from the low here. And really all I got to say to this is just wow. This is one of those things you just got to step back and be like, they came in with amazing numbers. Stock still fell. But what does that mean for me? When I see incredible numbers, I run my projections. What am I doing with the stock? Well, I was personally buying the stock when it was falling. I mean, it came back a little bit here, but if I see a stock I love that's fallen like that, I'm stepping in. I'm personally buying. What do I have for my base case here? Plugging in 20% revenue, 30% net income. Analysts are actually a little bit higher than this, in my opinion, looking at what I've seen, but I'm putting in 20 revenue, 30% net income. A 25 PE, I think would be fair for that. That's about where they are right now. So I get a 26, maybe 27% CAGR, and even running a bear case, this would be horrible for SoFi. Say they only do 20% net income for the next 3 to 5 years. 20 PE, still getting a 10% compounded annual growth rate here per year. That's pretty incredible, even with a bear case. Don't even get me started on this bull case if this would play out. So I'd say huge buy here, strong buy. That's what I've been doing, but run your own numbers here. You might have numbers different than me. Plug those in, do your own research. So that's all I got for you today. There were some incredible earnings last week. If you guys like this content, love a little like button. And if you just like all of this content in general, feel free to subscribe. And I hope you guys have a great rest of your day. See ya.